Actually, before coming here, I was at the University of Washington School of Law in Seattle for 13 years, so almost as much time here as back in the Pacific Northwest. Most of the courses that I teach here at Georgia State are in the area of wills, trusts, and estates, as well as federal taxation. This semester, I'm teaching property in our evening program, so I have the first year students in their second semester of law school, and we huddle up for 4 hours every Wednesday night and talk all fascinating things, property law. They pay for the whole seat, but they only need the edge. Given that today is April 15, it strikes me as appropriate for me to maybe lean into my background in tax law as we talk a little bit about how the tax law works and give you some exposure to what you might expect to see in the typical law school class. Normally, you would have received a reading assignment of anywhere from 15 to 30 pages in length that would require you to read a number of judicial opinions, perhaps some additional supplemental sources. Because I teach tax law, we also take a pretty good look at Title 26 of the United States Code, known as the Internal Revenue Code, or just to all of us who study it, the holy and sacred text. That tax law is going to be the basis of what we would do, and normally you would be getting some stuff ahead of time to be able to read, but because we wanted to encourage attendance rather than to discourage attendance, we didn't give you a reading assignment for today. But that's okay, we can give you enough background information before we have a discussion. Regardless of whether you were talking about an income tax or a sales tax or real property taxes or the like, every tax is computed with reference to a tax base, and that tax base is applied to a rate of tax. So when I pay real property tax, for example, the tax base is the fair market value of my real estate, and the rate is set at a set percentage. So whatever is that percentage of the assessed fair market value of my property, that's the amount of property tax that I have to pay. Sales tax is the same thing. Basically, this is the retail sales price of an item times whatever is the applicable state and local tax rate. For the federal income tax that most of us in the room are intimately too familiar with, perhaps, the taxable income you have, our system uses what we call progressive tax rates. That is, everybody's first dollar of taxable income is taxed at a lower rate, 10% tax on the first dollar of taxable income. We all do. But then, if you start to progress into the other brackets, as your taxable income goes up, the rate of tax that applies on your last dollar will likewise go up. So if you have taxable income of $100,000 and you are unmarried, well, use a $ as your profile pic. Somebody will be swiping right and you won't be unmarried by the end of the year. But if you have $100,000, can you see from the chart where your last dollar would be taxed at 24%? Because your taxable income exceeds $95,375, right? Mm-hmm. So that person would say, well, I'm in the 24% bracket. That's a little bit misleading, of course, because you're ignoring the fact that, well, the first $11,000 was only taxed at 10%, and then another chunk was only being taxed at 12%, and so on up. But the last dollar, to say that you're in the 24% marginal bracket, is going to be an accurate statement. Now, how is it that we go about then defining what constitutes your taxable income for a particular year? Well, here, the Internal Revenue Code, Title 26 of the United States Code is the Internal Revenue Code. Section 63, and in particular subsection A of Section 63, defines a taxpayer's taxable income as gross income minus the deductions that are allowed. The way that this is reflected on the Form 1040, the individual tax return, down here at the bottom, the very last line on the first page of the return is where you have computed your taxable income figure. But in order to get there, the statute says that you have to start with this concept called gross income, which the tax return defines on line 9 as your total income. I guess if we called it gross income, it would be a little stigmatizing. So on the return, employee, flat out man.
Is that taxed at a higher rate because of the secondary income?
Nope. Income is income. Instead, the taxpayer in this hypothetical has $4,990 of gross income that's going to be taxed at a 37% rate. Now all of a sudden it's no longer a $10 painting, right? Now all of a sudden it's become a $1,500 painting by the time that we pay our taxes. So under the bargain purchase rule, we say that when you buy property at a discount, you don't have gross income because the benefit of the bargain has not yet been realized. Y'all have a talent for this. You should be looking at tax as not just a class, but a potential career. I mean, you know, okay, there's human rights and all that stuff, but come on now. This is tax, right? This is affecting everybody you know. Not everyone you know is going to jail, I hope. Not everyone you know is going to be a victim in an auto accident, but everybody you know is affected by this stuff, right?
Yeah.
Next up, taxpayer buys a used piano from an unrelated party, paying an amount equal to the piano's value. So no bargain purchase there, just paid whatever was worth. 7 years later, while cleaning the piano, taxpayer discovers $4,000 in cash hidden inside. Lest you think these are all far-fetched, this is an actual case that came out of Ohio in the 1960s. Okay? Couple buys a piano, 7 years later, when they finally get around to cleaning it, when they're like, how come every time I hit G, it just goes boom, 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 instead of making it up? I don't know, just keep playing. Okay, we open it up and sitting on the G string, well that's not good. Sitting on the piano chord is this cash that's there. Does the married couple, do they have gross income? By the way, in the real case, of course, the taxpayers had filed a return in which they included the $4,000 in gross income. At a dinner party, they're talking about how they found the cash inside the piano. I mean, that's great dinner party convo, right? And they say, yeah, but we had to pay tax on it, to which all their friends are like, you put that on your return?
Right.
How is the IRS going to know
Right.
about that? And they got to thinking of like, you know, you're right. So they